Hi everybody, this is Thomas from Wynn Capital with the 2024 second quarter market summary. On the screen is my contact info and connect anytime if you've got questions or comments. As most of you know, I've hired a new advisor, Susan Landry. We're excited to have Susan on board, and on the screen is her LinkedIn page. So if you want to connect, you're free to do so. And in the email, I'll give you Susan's email if you want to send her a note. For perspective on where we are in the market, let's take a look at the S&P 500 for the last 3 years, and then we'll zoom in on 2024. Over here on the far left is 2021, and all-time market highs were made at the end of 2021. We then, of course, had a very steep decline in 2022 and rallied back to the old highs. It took 2 years to get back to the old highs, but in 2024, after a slow start, we've been making almost daily new highs all the way up until April, and then we had a small decline, but we've been rising ever since, and we're very close to the most recent all-time highs. I want to zoom in on the third quarter. We're going to review the second quarter, but let's take a close look. So the end of the second quarter is here, so we've got a few days in the fourth quarter. And I've highlighted 2 dates, and most of you can figure out what that is. This is the Monday after the assassination attempt, and this is yesterday. This is today that I'm recording. It's 10:13 on the Pacific, and the market's still open. So the market's very little change today, but very little change in these 2 kind of dramatic news events. The market digested the news and prices remain stable. So I'll have more to say about that at another time, but I thought I'd point that out. Okay, let's get into the second quarter. As usual, here we have the second quarter returns by class, by type of classes or types of investments. So we've got the US market going up again, the foreign developed down. Emerging markets had a very strong and uniquely strong, as they've been weak for a long time, but they're bound to rebound. And global real estate was down. Slight gains in the bond market. I love this for perspective down here, the best and worst quarters. It tells you that the kind of volatility you can expect from stocks is, minus 22% in a quarter and positive 22, so huge range. Even larger ranges for foreign, even larger ranges for emerging markets. And there's more risk and volatility. Most people don't know that emerging markets have higher returns than more stable countries. But you have to suffer large declines and enjoy the large rallies. Global real estate also has huge swings in value with big years and terrible years. And then bonds, which are a little more safer, a much more modest amount of volatility and the range of returns. So now we're taking a little bit of a longer view of market returns by class. We've got the trailing 12 months, basically 1 year, the last 4 quarters, and huge gains for the US, which is leading all of the other equity returns. And at least for this 1-year period, bonds are starting to recover. Over the longer term, this reflects the negative bond returns that we had over the last 5 years on average. And then over the 10-year period, it shows very, very strong returns with the US dominating all the other classes. This next slide is the world stock market performance just for the quarter. So it begins the beginning of the quarter and the end of the quarter. And both good and bad news throughout the whole period, but a rising market in the face of both favorable and unfavorable news. Here we see the same data set, the world stock market performance with the headlines, except it's a longer period for 12 months. So this later in the period is the repeat of the fourth quarter, but tons of good and bad news during the whole period. But in general, obviously, the market started to make a series of new highs through most of this year so far. So now we'll get into looking into some detail about each of these classes or types of stocks. This is the U.S. large growth led by the Magnificent Seven, which is they're calling the large seven tech stocks nowadays, up a lot. And in general, when value and small does worse than large growth, we do a little bit poorer in general. Sometimes we can overcome that through other means, but in general, we overweight or tilt slightly towards small cap value and we underweight large growth. The reason is that over time, small value does better than large growth. And it's very transient when those, what we call premiums or dimensions of expected returns, happen. But if you stay the course, you're rewarded. And then it's got a breakdown of all the categories over pretty long periods of time and their performance. I'm going to highlight that 63% of the global market cap is in the US. We dwarf the rest of the world. Everything is in this little small bit. All the other developed countries and emerging markets are there. And I just came across a stat that this changes dramatically over short periods of time. But we are at what may be an all-time high as far as our dominance in the value of our stock market. So here we have the other developed countries, and they're a little bit different. Small cap was the worst performing, but value was a better relative performer. So it was kind of a mix. Growth was in the middle, and large in the middle, large and growth in the middle. Again, all the historical gains are over in this grid, and again, we're looking at the very relatively small amount of asset value that is in developed countries. And finally, we've got in the equities, the emerging markets, which include China, which is interesting that their economy is so huge, but the value of their assets is tiny because there's a lot of other countries in here, but this little slice is dominated by China, which is still considered an undeveloped economy. And the returns over long periods of time can be seen over here. Everything did positive, and in the emerging markets, it was small cap and value that did better than large cap and growth. Always interesting to see the dispersion of returns and the range of returns for all the countries. And there's always the global average is here. So the global average was up, and on the very far end, you've got Mexico with a terrible return, and Turkey with a huge return for the period. And this is normally very, very volatile with big losers and big winners on both sides. The U.S. is slightly above average, so the U.S. was doing good as well. Another chart that always shows huge volatility and dispersion of returns is the commodities, and you can see coffee is the top gainer. Cotton is down significantly. A real mixed bag with not too much of a pattern of one sector dominating. But also, it's interesting to see that in this period of inflation, which helps, commodity inflation is one of the main drivers of overall inflation, and positive quarters. But over the last 10 years, we've really had a decline in the value of this basket. It's cheaper over time to own these things and to buy these things over the last 10 years. And finally, our last slide is an explanation about the Magnificent Seven, which are these very, very large and very famous and well-known and largely owned and popular tech stocks in general. So they have an expected return each year, and then when their earnings are better, they do better, and when they do worse, they do worse. Basically, this is an argument as DFA is always going to make, because diversification beats concentration over time. But when this happens, there tends to be more and more investors that do momentum trading, basically trying to own the things that were good last year, and at least in the past. That hasn't worked. There's massive data that shows that hasn't worked, but still hard to convince people to go with diversification when this is going on. But it's all about that. Okay, that's it for now. I hope you find this helpful. Again, all my contact information is on the screen. And if you have any questions or comments, please reach out anytime. All right, we'll see you soon. Bye-bye.